Good day to all, I'm Charmaine, iFAST Research Analyst. In the pursuit of financial prosperity, many Singaporeans aspire to build an investment property portfolio seeking a reliable income stream. The avenue often explored for this endeavor is Singapore Real Estate Investment Trust, offering investors the opportunity to partake in the property market. However, recent developments have cast a shadow over this seemingly lucrative investment landscape. October 2023 witnessed a decline in share prices within the S-REIT sector, with notable entities such as 𝗪𝘃, ARA US Hospitality Trust, and CapitaLand China Trust experiencing substantial drops. A cautionary tale unfolds with Manulife US REIT, whose property portfolio valuation plummeted by 14.6%, reaching the MAS regulatory leverage threshold. The MAS had previously raised the leverage limit for S-REIT in response to pandemic-induced challenges, highlighting the need for caution. The nightmare doesn't end there. A stress test on the top 10 S-REIT by market capitalization reveals vulnerabilities. A 1% increase in implied cap rates, a key factor affecting property valuation, could push leverage close to the regulatory limit. The average available buffer is a mere 4%, emphasizing the fragility of the situation. Further scrutiny unveils disparities among S-REITs, with Fraser Logistics and Commercial Trust exhibiting the largest buffer at 29%, while Mapletree Peninsula Commercial Trust, Suntec REIT, and Keppel REIT face the abyss with no buffer due to high gearing ratios. Diving deeper, a second layer of stress testing examines the impact of a higher interest rate environment on S-REIT's cost of debt. Entities like Fraser Logistics and Commercial Trust and CapitaLand Escort Trust could see a staggering 50% increase in their cost of debt, magnifying refinancing risks. After accounting for refinancing risks, some S-REIT are estimated to operate at lower interest coverage ratio below 2.5 times, subjecting them to a reduced leverage threshold. At those levels, this S-REIT would have no buffer and would thus breach the regulatory leverage limit. The implications of breaching MAS limit are stark. Distressed property sales, equity fundraising, and abandonment of distribution policies become looming threats, as evidenced by recent cases. To get the full analysis, scan the QR code or click on the link in the description below. Next up, 𝗪𝘃 will talk about the Schroder ISF Global Sustainable Growth Fund. Over to you, 𝗪𝘃.
Hi everyone, my name is 𝗪𝘃 and I'm with the research team here at iFAST. So following an exhaustive selection process, we proudly announced the Schroder ISF Global Sustainable Growth Fund as our top pick for global equities in the upcoming fiscal year of 2023/24. This fund stands out for its unwavering commitment to capital growth through strategic investments in companies boasting sustainable business models and robust fundamentals. The investment team's proactive approach seeks out enterprises with a growth gap defined as material differences between the underlying fundamentals and market estimates of its future earnings growth potential. What sets the Schroder ISF Global Sustainable Growth Fund apart is its meticulous portfolio construction. Employing a predominantly bottom-up methodology, the fund also integrates a thematic assessment, adding layers of depth and conviction to its understanding of long-term structural growth trends within selected companies. So top 10 holdings of the fund include the likes of Microsoft, Alphabet, and Elevance Health. A testament to its prowess, the fund has consistently outperformed both its peers and the benchmark, showcasing an impressive track record of delivering superior returns. Notably, this achievement has not come at the expense of risk management, as the fund demonstrates a commendable ability to navigate downside risk effectively. In essence, the Schroder ISF Global Sustainable Growth Fund emerges as a beacon of excellence in the realm of global equities. Its emphasis on sustainability, coupled with a keen eye for companies with a substantial growth potential, aligns seamlessly with our investment philosophy. And as we embark on the new fiscal year, we are confident that this fund's focus on quality will bear fruit as we head towards a higher for longer interest rate environment and a slowing growth environment. We look forward to a prosperous journey with the Schroder ISF Global Sustainable Growth Fund as our preferred choice for navigating the global equity landscape in 2023/24. To get a full analysis, scan the QR code or click on the link in the description below. Next up, we have Colin to share more about the global fixed income outlook. Over to you, Colin.
Hi, my name is Colin, Portfolio Manager at iFAST Bond Research Team. Today, I'll be sharing two investment views from our 2024 Global Fixed Income Outlook. Despite the climb in yields of longer tenor bonds in 2023, the case for short duration bonds remains compelling. First, yields of short duration bonds remain high following the steep rate hikes across major central banks over the past 12 to 19 months. Second, with the US economy proving more durable to higher rates and inflation remaining persistently sticky, we expect policymakers to push back against rate cuts. This sets up for a backdrop for higher for even longer rates in 2024, supporting yields of short duration bonds for even longer. At the same time, we do not think that Fed rate cuts will come early, contrary to what markets are expecting. Absent rate cuts, we see little capital upside for longer duration bonds. We look to turn positive on long duration bonds when the Treasury curve uninverts and re-steepens, giving investors a premium to hold longer duration bonds. When this happens with yields of short tenor treasuries at current levels, we believe a good point to add duration would be when a 10-year US Treasury yields hit 6%. Our second recommendation is to stick with higher quality bonds. A higher cost of capital environment exerts greater stress on high-yield issuers. In addition, the amount of maturing high-yield debt is expected to climb, and a maturity wall is expected to hit as soon as 2025. We think the repayment of principal on maturing high-yield debt in a backdrop of slower revenue growth is likely to inject greater liquidity pressure. At the same time, many high-yield issuers will also be compelled to refinance at a higher cost. From a valuation standpoint, global high-yield bonds also remain unattractive, with credit spreads being too tight relative to global IG bonds. Considering these factors, we continue to lean towards higher quality IG bonds entering 2024. On the top-down level, we prefer IG bonds over high-yield bonds. On the bottom-out level, we recommend IG bonds with relatively low remaining years to maturity. These are the list of our recommended USD and SGD IG bonds with shorter tenors. To get more of our 2024 fixed income outlook, scan the QR code or click on the link in the description below. That wraps up for the sharing of this week. Catch us again next week for more investment ideas and updates.